We're going to get to it today. It's really about the income. I know I keep seeing that question over and over on Facebook. What counts as income? What doesn't count as income? And I don't think I have it in this PowerPoint, but I want what just came up. You have a married couple. They're on the marketplace. Both people are in the application and one of them dies. What do? You leave the person who passed away, their information is still on the application. You just unclick that they no longer need coverage. But their income still counts. When they file at tax time, they still are filing as if they were married for the entire year. You don't want to go in there and remove that person's income and put them as single, especially if you put them as single with that household income, you're going to mess with their tax credit. So you just make sure that person's no longer getting coverage. So you can end it, as soon as you find out, you can end it that day. They'll get reimbursed. Don't panic too much about, well, they died 2 weeks ago and I need to reverse it. No. Ironically, this is one of the things that the insurance companies can reach back out. So they will reach to the marketplace and say, this person's coverage ended on December 12th because they died December 12th. So it'll backdate, it'll get fixed at tax time. The next year, you remove all of the information on the deceased spouse. So the year that they die, you leave their information on. Now, if the person who passed away is the primary, just kind of, just talk to the person, let them know. Say, hey, the IRS, still counts you as married for this year. You're still going to get some documentation in, Bob's name. Next year, we won't. Just let them know that. So, because, somebody just died, it's kind of hard to see that person's name keep coming in the mail, right? But if they know, they're okay with it. Number one thing to remember, people are not afraid of quote unquote bad news. It's the surprise. So if you let them know that's going to happen, they're okay. All right, they're prepared for it. It's the surprise. Why am I getting all this document emails in his name and he's not even okay? Let them know and then they go, all right, they get it. So just remember that you be honest with people. They're okay with it as long as they're not surprised with it. All right, so today I'm going to have a PowerPoint. Some of you have taken my course at the ACA Academy will recognize this. I'm actually combining two of them. I'm going to combine this one as well as the tax credit calculation. Every year there's questions. How does this work? How does this work? How does this work? What's the income? So we're going to go over this and I will pause at two different spots to take questions. I can't see the questions right now because then I get to, but if I know I've got Josh on and Samantha, somebody else, if you know the answer, feel free to answer it. And then I will pause. And Jill, you said, if we call the insurance carrier on behalf of a client, is that acceptable? And does the surviving spouse need to notify the carrier? You don't need to call the carrier, just terminate the coverage. Usually the hospital is who notifies them because they will send a deceased, there is a code for what they have to pay. So you don't have to call the carrier, just go on the marketplace or Health Sherpa and terminate their coverage. All right, so marketplace, tax credits, income, how does that all work, right? That's the thing. If you understand this, you're better than 99% of your clients. They don't understand this. This is why they need experts. All right, so who gets tax credits? Everybody. 0 to 64. Adult children no longer on their plan, right? Employer-sponsored coverage is not offered or it ends, they retired. And the bottom line, those who are 65 and are not eligible for free Part A Medicare. That question always comes up. But if they have a 0 Part A, they cannot get the marketplace. So they have to pay the Part B, But don't assume the marketplace is cheaper. Because if somebody's making high income and they don't get free Part A, sometimes the marketplace is still more expensive than if they just paid the Part A premium. So, but that is in a nutshell who gets it, right? So what are they looking for? What do you need to know to get the tax credit? So they need the MAGI. And I know people, what? The MAGI? It's the modified adjusted gross income. I'm a pastor's kid, so I think of Magi as the wise men. But when I typed in Magi, there was this, I don't know, some kind of MAGA, but it's the modified adjusted gross. And you cannot find that on a tax form. So if you look at your taxes and you look at every line item, there's nothing that says modified adjusted gross. There's adjusted gross, but not the modified. So to understand that, the modified adjusted gross this is how you get your gross, which is your wages and taxable interest and all the stuff that we tell the IRS is taxable income. And then you can deduct some things, student loan interest, IRS, there is deductions. Now, again, you are not an accountant, so do not, you don't have to go through every deduction. That's on the accountant side. But the big thing is the other income. This is what will trip you up. So other income is non-taxable Social Security payments. Foreign income from living abroad, interest income not taxed by the IRS. And that one I'm like, I don't even understand how that works. If I'm not telling the IRS about interest, where would I put this on here? And scholarships could be counted as income, not always, but it does sometimes show up on the tax form. So if they think it's going to be, I'd rather you include it and make their income higher, and then they get a reimbursement back at tax time. But the biggest one is that non-taxable Social Security payment. You need to report gross Social Security, not part. Some people are like, oh, I don't pay taxes on it. Yep. But the government knows you're getting this money. So I don't use the phrase your taxable income. We just say adjusted income, our document, which I'm going to show you what our income doc just says, gross Social Security. So that's where kind of it looks a little different. I don't have any of this. People are like, I don't have that. You might have it. You don't understand any of that. Here's what it looks like, right? A modified adjusted gross plus non-taxable Social Security benefits, tax exempt interest, include foreign income. That's your modified adjusted gross. So 99, I've never done the tax exempt interest, and I've never put in excluded foreign income. And I've been doing this since it started. Now, I'm sure there's some people who have had to add that somehow, somewhere. I'm still not sure how the IRS would know if it's not being reported, but that's what the modified adjusted gross income is. But it's really the first two. Now, if somebody is not collecting Social Security, guess what? Their adjusted gross income is the modified adjusted gross income. It's pretty easy calculation. So this is a 2021 document. They're changed every year. But on 21, and I think this year it was like 20, it was like 12 or whatever. That's where you'll see adjusted gross income. If somebody's like, I've been making the same income every year, all right, bring your tax form. We'll look at it. So it'll say adjusted gross income. Now, if they do not collect Social Security, that's it. That's their yearly income right there. If they do collect Social Security, it's listed right here in these little extras. And it will say 6A is the gross Social Security amount. Now, depending on how much their wages are, how much their pensions are, some of that Social Security may be taxed, like part of it, maybe none of it, maybe all of it. But this is where you will find the gross Social Security. So if somebody really doesn't know, now this tax form is only going to work if they had the same income last year, right? They can't bring you their 2023 taxable income. Last year they were working full time. Like, that's not going to help. But if somebody's been, okay, yep, I got my taxes and it's the same income, this, you can find it. So then you got your gross. Now you look over at 6B. That's the taxable amount. If 6B and 6A are the same, then line 11, the adjusted gross, is accurate. But if 6A and 6B are not, you have to do a little bit of math. So here's my math. If 6A and 6B are not the same, you take line 1, or well, actually you take your adjusted gross income of 30,000, you subtract the 805, not the taxable Social Security, and then you add line item 6A, the gross amount. That's the
Hey, Chris.
adjust. Yes.
Oh, I just had a quick question because I cut out, but so on the Social Security income, it's already taxed, so you take the full amount. Is that correct?
Yep.
Okay.
It's still the gross. It's not your Social Security after taxes. We have to report the gross amount.
So it's the full amount because it's tax free.
Whether it's tax-free or not, you have to do the gross amount.
Okay.
For this person, you have to put 15,362. So if your client tells you, walks in and says, well, my income's 30,000, that's my adjusted gross. Their income is the modified adjusted income is 44,557. That's a significant difference in tax credit, and they're going to have to pay it back at tax time. And I do know there are accountants who do not understand this. To this day, Marketplace has been around. They've been doing this since 2014. There's still some accountants, and now I'm not talking like the career accountants. I'm talking about the pop-up, the H&R Block that's suddenly showing up at Walgreens, and this is their part-time job. They do not know how this works. And so your client, just somebody who's low income or, Social Security and pensions, like, well, every year I keep having to pay back. And my accountant says that Obamacare is really sucky. This is why, because they don't understand where the modified adjusted gross is coming from. So you want to make sure your client is not telling you 30,000, they're telling you 44,557. Because that's a big difference. Any questions on that? So that's the income. Other than that, it's everything. So I'm going to stop sharing my screen. And I'm going to show you my income document, which I have shown before. But this is what we do. We send this out to everybody, whether electronic or paper or whatever. It's the same form every single time that we send out. And it should look familiar. This is exactly, I copied this income source. I copied that right from the Marketplace, right from the application. There's everything they want. So job, the name of their employer, gross amount, self-employed, net income. That's the only one that's net, right? So it's their gross minus their expenses, unemployment payments, Social Security gross amount, pension payments, withdrawals from a 401k, an IRA, not a Roth. Roth IRAs are not taxable income. Investment, capital gains, property, income minus expenses. If they own a couple condos, what's their adjusted gross? So that's a self-employment kind of thing in a way. They make $1,000 a month, but they spend $500 a month on fees. So they're only making $500 a month in rental income. Taxable income, taxable alimony. That one's always tricky. You have to ask them, is this taxable? So were they forced before 2019 or after 2019? If it was before 2019, the alimony they receive is taxable. If it's after 2019, it's not taxable. So those are the premiums. Now, there are other options on the Marketplace application. Gambling, I've actually used once. Somebody made a lot of money. He was mad because he had to tell me about it. There's other income. If investment is kind of my catch-all. Now, I'm going to explain Social Security. Somebody's talking to you in November, December. They say, I'm going to collect Social Security in July of the next year. So then you say, oh, Social Security, and you calculate it correctly. You only calculate half a year, and you put that in. Often, it will ask for income documents. Can you take a guess why it's asking for income documents? Because Social Security doesn't count yet. It doesn't exist. So you're telling the IRS system, the Marketplace system, that this person's collecting Social Security, and they're talking to Social Security and going, no, they don't. because they haven't applied yet. It's in the future. So in that situation, don't say Social Security, just say investment 6,000 instead of Social Security 6,000. As much as the marketplace makes us do line item by line item, the IRS does not care. The IRS only cares about total for the year. If you say they make $40,000 in a job, but they make $40,000 in investments, the IRS is not going to go, oh, excuse me, naughty you put 40,000 in a job. They really don't care. So yes, we want to put that down. Mostly, I'm going to tell you the reason I want to do it this way is so that the client remembers where they said their income was coming from. Instead of just saying 30,000 and they go, oh, it's the same income. And then you find out it's not the same income. They got a part-time job. They went over there. So you kind of want them to look at this every year, but don't panic. If, they got a new job and they switch jobs, and you don't even have to list, they had 3 jobs in a year. You don't have to list all 3 jobs. Because again, the IRS is not going to compare how you listed the income on the application. All they want to know is the dollar amount. So Rosalind, you actually said, how about sales from a house or property? I always say it's income. And then somebody came to me and went, guess what? It's not income. I was like, oh, awesome. Because it was a first time something capital gains. So I would rather count it as income. So I tell them, all right, let's count it as income, but talk to your accountant. Because maybe it's not. If it's their first time capital gains, they don't. It doesn't count as income. Like, I'm not an accountant. I would always rather err on the side of counting it as income than not. Same with life insurance. Somebody goes, I just received a life insurance policy. Does that count? 99% of the time, no. It does not count as taxable income. But there are some exceptions to the rules. One exception I know of, because I work in group benefits, is if the employer is paying your life insurance. So if I'm paying for my assistant John's life insurance and he dies, his wife is not going to get the $25,000. They're going to get $25,000 and have to pay taxes on it because I'm the one who paid for it, not him. Again, I'm not sure. Usually life insurance does not count as income, but talk to the administrator of that policy because they're going to tell you. Talk to your accountant. Talk to your financial advisor. So if you are not currently contracting or networking with financial advisors, accountants, do it now. Don't bug the accountant during tax time because then they're not really going to be happy, right? But you need to get those investment people. So this is the tax document. Yes, there are more deductions listed. I actually rarely even include them at this point. If the income cliff comes back for 2026, we'll talk about it. Then you want to get every single deduction you possibly can because you want to keep them at the 400 percentile, not at 405 percentile, the federal poverty level. But until that happens, don't worry about it. Now, if they know they have a student loan interest deduction is $20 a month, you can put it in there, but it's not going to affect it. Because I'd rather err on a little bit more money than they're actually making, and they'll get tax money back. So this is sent out to every one of our clients every year. Income docs. And it does help because we're putting it right there, the line item. So, and I have clients that go, I don't know what my income is. And so I just pull up that document and go, all right, got a job? All right, got Social Security? And then they see how easy it is. I think people they just panic.
So real quick, so it kind of sounds like you're like an accountant as well.
I know enough to be dangerous.
So I mean, if they have a pretty confusing situation, you can always refer them back to their accountant then.
Absolutely. Okay. I just say I've heard, like the property sale. We get that. Is that income? And I go, I would assume it is, but occasionally I get told it's not. So talk to your accountant. Okay. The reason I've learned about this is not actually talking to accountants. It's talking to clients who come back and tell me what their accountant said. And so I'm like, oh, that's interesting. Like I learned from a client that their children file separately. Now these are dependents. And I was like, wait, you can do that? And they're like, well, yeah, there's a button that says, is somebody else claiming you as a dependent? They just click that button. So I was like, all right, so now I have a 17-year-old who filed taxes for the first time, and I helped her file her taxes so that she can go out. I never heard that before, but a client told me. So I learned a lot of this from talking to your clients. And those are, when you have a client who will come back and tell you what an accountant said, reach out to that accountant. Say, we have a mutual client and they came in and talked and they told me this. This is fascinating. Can we talk? Can I just have a little one-to-one? Because I work on the marketplace and I do not want to be an accountant. You know, if you can find an accountant who understands how this works, they will refer people to you because they go, okay, here's an agent who understands how it works. So you are a bit of accountant, but you have to make sure you say, I don't know. Even if you think you know, oh my goodness, the tax law changes all the time. Did you guys know the tax law changes all the way up into February of the year that you're filing for previous year? So, you know, we have to file our taxes for 2024 by April. Congress is still making laws for 2024 in February. What? So maybe you had a degree, maybe you did accounting before. Do not assume. They are changing those rules all the time. All right, so we will be talking about that, about not making the minimum. So I will get back to that in a second, on our next thing. Any other questions about the MAGI, understanding what is or is not the modified adjusted gross? Okay, I don't see any others. So now we're going to talk about the tax credit calculation and how that works. Let me share my screen again. All right, tax credit calculations. It's pretty simple. It's not as complicated as you think. You do not have to be an accountant to understand this. So tax credit calculations, we learned the MAGI, right? The adjusted gross plus non-taxable Social Security. That's your modified adjusted gross. So eligibility for tax credit is based on household income for the year, whether the coverage is needed or not, right? You always have that one person's like, well, my spouse is on Medicare or on my group plan. Doesn't matter. IRS, household income. There are no income brackets. Somebody will ask you, well, what's my next bracket? How much money do I make before I get to the next tier? That's somebody who's talked to an accountant, because there are tax brackets for that, right? It's like, oh, you're in the next income bracket, but not on the marketplace. The calculation for everybody is based on the second cheapest silver plan in the county for the individual and family based on their age and income. It was 10%. It's currently 8.5. Next year, 2026, it's supposed to go back to 10%. We'll see. So if the rate of the plan, so that second cheapest silver plan, if that plan costs more than 8.5% of the modified adjusted gross, then the household gets a tax credit. There is no cliff. Anybody who says, oh, you make too much, no, there's no cliff. That's pre-COVID when that was happening. This cliff might come back for 2026, but we will wait to worry about that until 2025. If the plan is already less than 8.5% of their modified adjusted gross, they don't get a tax credit. And if somebody makes $1 million and they're like, I don't get a tax credit, they're paying less than 8.5%. If somebody makes 300,000, I don't get a tax credit, you're paying less than 8.5%. The reason you don't have a tax credit is because it's already less than 8.5% of your income. Oh, the poor people are, getting that tax credit. You're paying the same amount. In fact, your percentage is better than those who are poor because it's less than 8.5. So the percentages are pretty fair. In reality, everybody's paying similar percentage of their income. But it's confusing, right? Because somebody thinks they make too much. Oh, I'm getting screwed because I make too much money. Nope. You're paying roughly the same percentage as somebody who makes a third of what you make. So things to remember, your tax family size matters. Taxable income matters. If the IRS cares to know about it, then you need to know about it as the agent. If the IRS doesn't want to know, I don't need to know. If somebody's getting cash tips under the bar and works down the street for cash, all right, I am not the IRS police. I'm not going to worry about it. That's theirs to worry about, you know? So if the IRS is told, is what I tell people. If you have to tell the IRS, you have to tell me. If your accountant says this doesn't go to the IRS, or your financial person says this to the IRS, then I don't need to know about it. Some people will think they need to tell assets. That might be because of Medicaid. So Medicaid calculates differently. The state programs will count assets. Oh, you're sitting on $1 million property? Yeah, we're not going to give you Medicaid. The federal government says we don't care about your $1 million property until you sell it. So they don't care about your assets because you're not getting taxed on assets. So just kind of remember that. All right, this is what it looks like. I'm going to assume you guys know how to do calculations on the marketplace. So couple age 43, 42, their income's at 45,000. They get a $670 a month tax credit. So cost of the plans before is on the left. With the tax credit, you can see how it is. All right, 86, $162, 310. The silver plan is the one that costs roughly 8.5. And by the way, when I say silver, I am using the second cheapest silver plan. So on the left, $832 is the second cheapest silver plan in their county for their age and their income. So they add $670 to make it about 8.5% of their income. Now we have a couple 10 years older. Same income. Look at the size of that tax credit, right? Here's the young couple. What's their silver plan cost? Older couple. What's their silver plan cost? $162. Because their modified adjusted gross income is the same. So they're paying, both couples are paying about 8.5% of their income. Now this couple's 20 years older than the 40-year-olds. Their tax credit's huge, but look at what they're paying, $162. Now the bronze plans and the gold plans, those ones will adjust. But the silver is pretty much the same. And typically, not always, because bronze plans can be expensive, but in theory, the bronze plans cost less than 8.5% of your income. And there are places where the gold is actually the cheapest. So these are just averages. You might have exceptions to the rule. So now this couple's making $20,000 more. So instead of 45,000, where it was only 162, they're now paying $442 for that silver plan, because that's about 8.5% of their income. So they're paying the same percentage as the couple that's making $20,000 less. This couple, 85,000. All right, they're paying 602. It's more, but they're also making $40,000 more than the $45,000 couple. And even at 105, now this is the 60-year-olds, they're getting a tax credit of over $1,000. So they're paying more dollar amount, but they're paying the similar percentage. So if you start speaking to your, especially your prospects, about percentages instead of dollar amounts, it's usually better. Like, so the first conversation with my client is I talk to them, I ask them all these questions, I figure it out, and then I'm like, okay, I'm going to tell you the marketplace works. They take and make the second cheapest silver plan, roughly, I tend to say 10%, but 8.5% of your income, so that everybody's paying the same. And then I show them the rates. But I'm putting that percentage amount in their head, because I don't think paying $1 for every $100 you make is an unreasonable amount to ask. So it's pretty good. Now, if the cliff comes back in 2026, if you make over 400 percentile of the federal poverty level, you will get nothing. Again, Don't worry about it. Don't panic about it. If you have somebody who makes a lot of money, we have clients that are like, they retire, they make good money, they're self-employed, they're making really good money. You can just let them know there is a possibility in 2026 that the income cliff is coming back. If it is, I will let you know. And please reach out to your congressman. Please reach out to your congress lady, because this needs to be fixed for 2026. All right. One couple, this is where it's a little bit weird. So we have a couple, one 63-year-old and one spouse is on Medicare. They're getting 65,000 and they're getting a tax credit of 468. I don't know if you remember when it was both of them, they were getting over $1,000. So that's silver plan is 424. The bronze plan is 343. So it went up, or the tax credit went down, but they're still saving over $5,616. But if you look at their silver plan, it's the same amount. 424. It's the same. It's still the same percentage. The bronze plan is what changes. So here's the couple when they're both on the plan, and here's the couple with only one person on the plan. Ironically, the golds go down, the bronzes go up, the silver stays the same. So love math, right? You all were like, woo, percentages in math class. If you are, you're probably an accountant and not on here. But all right, so bronze and gold plans. Again, this is just the typical. Bronze plans will usually cost less than 8.5%. Golds will usually cost more than 8.5%. There's usually one cheaper silver plan because they're using the second cheapest silver plan. In our area, the company who is the second cheapest silver plan, their cheapest silver plan is $1 less. So there isn't really a second cheapest silver plan. The company, the insurance company who comes in with the second cheapest silver plan dictates the tax credit for everything, which is why we want the carriers to be similar in rate. I have been in years where the second cheapest silver plan was $300 cheaper than the next cheapest silver plan. It screwed everybody who didn't fit that network with that cheap silver plan. It's getting better. The more carriers in the system, the more years they're in the system, it's better in the area because they tend to be close to each other. But you'll get some new person, you know, United's great at that. Anthem will come in with the skinny little network. We have Anthem that's got they only cover one network and they're really cheap. Well, that's because they cover one network, you know, so that's why the rates will change every year. It's because the sweet spot is that second cheapest silver plan. Important thing to remember, the baby tax credit. Child born on December 31st is given the same amount of tax credit as a child born on January 1st. The IRS does not prorate. Everybody kind of knows this. So this is my example when somebody's like, well, you know, I worked for half the year and I only need this insurance for half the year, so I should only have to count half the year's income. Nope. Think like the IRS. And by the way, everybody hates the IRS, so you can always blame the IRS if people get mad about things instead of you. It's the tax credit. Everybody knows that, you know, that baby born on December 31st gives you that child tax credit for the whole year. Income is the same way. The IRS doesn't care when you make your income. They don't prorate it. You won the lottery on December 31st. They're not prorating it that you only had it for one day, right? They're going to take it for the whole year. All right. Questions. I think I saw some questions coming up. All right. So question is, if a person does not make a minimum or doesn't qualify for Medicaid, I know there are no penalties for making less, but clients call every year and tell me their accountant says they owe money to the IRS because they did not make enough money. No, they did not. I would tell them to go to a different accountant. There's no payback. I don't know. I've never had somebody, I have. And I said, you need to find a different accountant because they don't know how this works. When you put on the application that you're going to make $50,000 and you make $30,000, does the IRS make you pay for the overage? No, they give it back to you. If you say you make 30 and you make 19, do they make you pay? No, they give it back to you. If you say you make 20 and you make 12, they're not making you pay it back. So if you have an accountant, if you have a person who says, my accountant says I have to pay this all back, you need to recommend that they either find a new accountant, or this is how I've also connected with accountants. I would love to talk to your accountant. Can I have permission to talk to them about you? Yes. And then you can build that relationship. So talk to the accountant going, all right, I've been doing this for how many years? I've never seen that. So the accountants just love to blame the marketplace. And again, it's usually not a career accountant. It's usually those quick pop-up ones, because they just don't know where that modified adjusted gross is coming from. Scott, how do children under 18 with part-time jobs work? If they make, I think it's 13,000 something. If they make less than that, don't even put their income in. The system won't count it. So, and I know I've seen this, I put in their income and it's just not calculating it correctly. That's because the system is doing what the IRS does, which doesn't count their income. So that's just how I learned, my 17-year-old made, I don't know, $5,000 maybe on her part-time job, or 3,000. So she filed her own taxes so she could get her $50 back in tax, how much in taxes, but she clicked the button that said somebody else is claiming me. So you don't have to include it. You just don't even put it in the system, because the system's going to take it out, and then people are going to go, well, wait a minute, we said we're making 40, but the system's saying we're only making 37. So it's nice. You don't have to worry about that. Yes, high income earners will complain. We do all this stuff and all the poor people are getting all the benefits. It's like, nope. That's why I start with the percentage. And you can even say, and everybody pays about the same percent. Wow, you make good money. You're going to pay less. You're going to be about 2% of your income. It's about perceptions. Now, I'm not saying we can't sell alternatives, though. The short terms are going away. So now the alternatives, you really need to think. Are they cheap alternatives because they're good? Are they cheap alternatives because they're not going to cover somebody? So percentages help. So Rosalind, there are no income brackets, but there are the CSR brackets, right? So there's not an income bracket, as in you're going to get $1,000 tax credit for the next $10,000. And then now you're making 11,000. So now you're going to get $800 of tax credit. That's typically what people are thinking is brackets. They're thinking from this dollar amount to this dollar amount, everything stays the same. And then when I go over it, it's going to change. If somebody makes $100 extra more, they're probably going to pay 10 cents, right? So we tell everybody, if you pay $1, if you make $1 more, you're probably going to pay a little more. But the tax credit, the CSR, that's a completely different thing, because yes, that part is bracketed. Yes.
So, but we need to know those FPL levels because of the 100 to 150% SEP. I use that all the time in Texas.
Right, but that's not an income bracket, because clients will say, what's my income bracket?
I just tell them it's a federal poverty level chart, that if you make between this and this, that you qualify for a special enrollment, because I get that a lot during the year. Yeah.
So that's a little bit different, because you're like, okay, there's a way you can enroll if your income's below 150%. But it's still not the income bracket. That's when somebody's asking you, they're asking you, how much more money can I make before the tax credit changes and I have to pay more? Well, if you take out 10,000 out of your IRA, you're going to pay about $1,000 more for your insurance, right? And then people will complain, and then I go back to the percentage. You're paying 10%. Oh yeah, you get to keep 9,000 of the 10,000. Oh yeah, okay. So there is a bracket as far as the SEP. They're just saying anybody who's below 150% gets that SEP. And again, that's supposed to go away. My personal opinion is I wish it would, for different reasons, but yes. Last year, Alicia I got an accountant on the phone and explained how the ACA worked, and she was able to fix it. Yep. This is a way to reach out. If if it's a pop-up one, the problem with that is they're there for tax season and then they're gone. But when they're doing it for their job, it's the career accountant. Talk to them, reach out to them, talk to them now so that at tax time, they'll reach out to you and you can help. And there's nothing better than their client saying, you know, Ruth is awesome. She tells me all this stuff about my insurance. Can I have her talk to you about this because I'm confused? You know, not too many accountants are going to go, no. And as long as you're approaching it as a, I just want to understand, you know, she's saying this and I've never heard of that before. Can you explain to me how you got that? And then you can go, oh, well, did you know this is how it works, you know, or whatever. So you can use those as an opportunity to network.
Chris, can you address Melissa's
Yep.
question? I was gonna start typing and I was like, this is a little bit longer of an answer than I should type out.
It was my next one. So Melissa says, if they are on your marketplace application and you receive a tax credit, they can still file separate. Yep. Because they're filing and they have to say that somebody's claiming them as a dependent. So they're not really filing separate as the IRS. They're not filing as a separate household. So they're filing separate, but they're not separating themselves from the household. So they're filling it out and they're just clicking. There's a button. Somebody else is claiming me. In fact, I think I have that tax document right here. I was helping my daughter. And then it just, then they line it up and they go, okay, that's the household, you know. So now I will tell you, since this just came up, I've had this happen. So somebody is in college, right? They're 22, 21. They're in college on their parents' marketplace. They are a dependent. They graduate in May and they get a fabulous job in June. I had a lady, she called me and she's like, take my son off my plan right now. I was like, okay. Now he was a civil engineer and he got a job making $100,000. And she did not want that $100,000 on her taxable income. Yes, we didn't want that either. There are ways, this is a good accountant, there are ways to separate the dependent at tax time with the tax credit. I do not know how that works. I had an accountant in my building here and she's the one who found it because I'm like, what do you do? Like, they didn't know they were going to get a job in August. And now they have this $30,000 that they don't want to apply to their income, especially back then because there were cliffs and then they would not get any tax credit at all. And so there is a way to separate. I don't know the logistics of it. I don't know how, but I do know it's possible. But if somebody's kid gets a job, just get them off the application as soon as possible. And then tell your client, I'm removing them completely off your application. Here's your new tax credit. Here's the new amount. And please tell your accountant to look into how to separate because you don't want to include that child's income on yours. Now, some parents don't care. There's not a cliff. They don't even notice it. But if that cliff comes back where they make $1 more than the cliff, they get zero tax credit and have to pay back $12,000. Believe me, they're going to want to figure that out. So you can separate it. Again, I don't know how, I just know that you can. What age do they start counting income over 13,000? I think it's at 18, but again, ask an accountant because that's when that changes. I mean, if you're 20 and you make 8,000 at a part-time job, it's not really counting towards income. If you put it on there as a tax dependent, it's not really counting, but clarify that with the accountant because they are changing rules all the time. Elise says, I tell the client that the pop-up just filled out the online questionnaire and didn't dig down into some of the manual things that a real accountant can do. Absolutely. And remember what I just told you, they're changing the tax law in February. Accountants are filling out, some computer programmer has created an account for them to just push in buttons. Well, if the programmer's wrong, the accountant's going to be wrong. And very few, especially the pop-ups, even some of the, career accountants will mess it up because the program was wrong. Man, those programmers, I'm telling you, it is all on them. Now, a good accountant will look at this and go, something doesn't look right, and then start kind of digging in. But they are relying on that programmer to be accurate. I remember in 2013 when the Affordable Care Act was starting and we were still trying to learn how all of this was really going to work. We kept running downstairs and knocking on the accountant's door. And she went, You guys, you know, you're just one of about 10 huge tax changes, and yours isn't even the important one. And of course, we're like, yes, it is. It's my job. Of course it's important. You know, and I'm like, oh, there's 10 tax laws and big tax laws that had changed that year. You know, so they're dealing with that all the time. Now, the ACA has been around a long time. There is no excuse for career accountants to not know how this works. But there's some of them, and maybe they're new. Maybe they were a pop-up one, decided they really love numbers and percentages and stuff, and now they're new at it. So always approach those accountants if you can. Go out there, talk to them, approach them, not like you're there to school them. You're wrong, you know. Go out there like, oh, you know, I want to understand. And then you might be able to show them. And if they refuse, if they're like, no, well, then you really do need to, you're protecting your client saying that's not a good accountant. You need to go to somebody else. Because if they're messing that up, who knows what else they're messing up. All right. Any other last questions?
Yes, Chris.
All right, Don.
Going back to part of what Rosalind's question was. So because I thought I had remembered too, like not, and this was pre 150% SEP, which I believe you said that's still in place, correct?
Correct.
Okay, so but I thought I remembered seeing a chart, I don't know, it's been 2 or 3 years ago now, that showed, okay, 150 to 200 was, you know, this, and then 200 to 250, et cetera, going up to the 400. And if a person was going to pay $150, which included the subsidy for their plan, at 151%, that they would still pay that at 199%. But then if they went over that 200% mark, then it went up in premium. So you're saying, I think that's not the case. It's just 8.5% period of whatever the income level is. It could go up every 10, 15, $20, whatever it is.
Correct. There's no chart that's showing what you're talking about, Donna. I do know what you are talking about. Again, it comes back to the cost of the plan. So there are some plans. Okay, if somebody makes $20,000, what's 8.5% of 20,000? See, I liked it when it was all 10% because that made my life a little bit easier. But 20%,
$1,700.
$1,700. So $1,700 divided by 12 is 141 bucks. But you will see a silver plan that costs them $3. So then they tell you there's some more income and now it costs them $5. So it's not like this perfect calculation. It's because the second cheapest silver plan and the tax credit and how that works. And again, percentages are fun. So that's why it isn't always just because you made $100, you're going to pay $10 more. But we do tell people, let us know if your income is changing, but only if it's over 1,000. Because sometimes it's so minor, it doesn't matter. And I definitely do not want to put them in a different CSR because they made $100 more. So there are CSR brackets. So, right, anybody between 100 and 150% of the federal poverty level gets a CSR, and 150 to 200 gets a different CSR, and 200 to 250% gets a CSR. So those brackets exist.
Yeah. Okay.
But that's a little bit different. That's not so much income bracket. That's just the CSR bracket. So you might be thinking of that. Because anybody over 250%, you do not get a CSR. Your plan stays the same, 250 and up. So if you're wondering what I'm talking about the CSRs, this is a good plug for me to plug my my class. So I do have an ACA Academy class, and I walk through those CSRs, which to me is one of the most important things you need to understand, how to protect your lower income people. So I do have a class at the ACA Academy, ACA-Academy. I'm happy to send out links for that. It will walk you through very much the detailed. If you buy none of the other modules, the CSR module is probably my favorite. I think that's the one that impacts people the most in their pocketbook when they need it the most, right? We're trying to sell people a product that we hope they never use, but when they use it, that it's going to cover them, and it's going to cover them well, and not put them into medical debt. So yes, I have the federal poverty chart. In fact, I'm going to show you the 2025 federal poverty chart is out. See if I can get it to work with this screen. Nope. See, it doesn't like this. There we go. It's out. We have one. It's very colorful. I don't need it for the 400. I use it for the CSRs. So you can look those out. It's a little confusing. The poverty chart for 2025 is actually the federal poverty chart of 2024. So, and I can tell you what you're looking for. The 100 percentile of a single person is $15,060. So there's charts everywhere. If you went through CMS, if you went and did your recertification, it was on there. The 400% is 60,000, which is huge. I mean, that's a big jump. So Jill, you've sat on 3 CMS calls and I basically said over that we're not allowed to select denied Medicaid if they haven't been actually denied it. They aren't watching it closely. So I'm going to do it if they can't get it. I've talked to my Medicaid system and they say, if you know they're going to be denied, just say that. Our Medicaid systems, at least in Wisconsin, is overwhelmed. And they're like, you know what, if you know it's going to be denied, please just skip the paperwork. So now, if you're not sure, you're not 100% sure, yeah. But if they're going to be denied Medicaid, you're going to wait, you're going to enroll them. It's going to take 2 months for them to be denied, and your backdate, it's not going to backdate their coverage. So they aren't monitoring them because the feds do not talk to the states. The states tell them who is and is not on the plan. So when you enroll somebody and it says, send us proof of their Medicaid coverage, that means they're on Medicaid. They have it. So the Medicaid, the state sends it to the feds who is on Medicaid. But we were just in training for our state of Wisconsin, was giving out some free CE classes, and we had somebody from the state, and there was a couple people who said that, and they're like, I thought the two systems talk to each other. Remember, the system is not smart. I'm not saying that's not going to happen. It's gonna. Eventually, the system's going to get smart. And if you're in an expanded state, it's already in the same thing, right? So, but the Fed system is not smart. I think they're doing that. I mean, I know why they're saying it, and I know because there's so many unethical agents who did that, who marked it when they absolutely should have been on Medicaid. So, you have to use your judgment, your call. Is to protect my clients. And my state told me, if you know they're denied, please don't send us the paperwork. You know they're going to be denied. And my child went without insurance for 2 months because I was waiting. And then I got a denial and I realized, oh, thank goodness I didn't have to go back. So when I first started doing this, so, it's up to you, how you want to do that. You have to go with what you can live with. And that's pretty much everything, right? You need to go with what you can live with. So you do what you need to do to sleep at night. And I think that should be with everything. I actually was horrified. We were listening to a consumer who had one of the unethical things happen to her. And I didn't know this was, I mean, I get the whole, I put him in a zero plan, blah, blah, blah. This woman was paying over $100 a month for insurance that she was told covered her plan. And then she ended up in the hospital. As she's leaving the hospital, they're like, your insurance does not cover us. Fortunately, she ended up reaching out to the state and they kind of helped her. But then they found out she was actually enrolled in a $0 bronze plan. She was paying that $100+ directly to the agency.
Oh,
This woman is walking out with a $50,000 hospital bill, being told that the agent who told me, yes, my doctor's covered, yes, my hospital, completely lied and was charging her for a $0 bronze plan. Now, she definitely went about it the wrong way. She went online and just typed in healthcare and, of course, got 1 million people calling her. So those are what we're fighting. That's what CMS is fighting. CMS is fighting those people. And unfortunately, we're all in that bucket as far as CMS is concerned. So that's why this 3-way call, as frustrating as it's the thought is, they're going to start seeing how important we are. And
so
we have to get our clients to tell CMS, I need my agent because they've helped me. If you can get I'm thinking about, during open enrollment, asking my clients, here's the number, please call them and tell them that you're thankful for me and that without us, you wouldn't have known what to do. Because that's what they want to hear. Remember, people complain. They only hear people complaining. You want them to hear the people saying, my agent helped me, my agent helped me, my agent helped me, my agent helped me. You want to hear that over and over and over again so that it's more than I got screwed over by some horrible agent. So Donna, you had a question?
Yeah, I'm sorry. So their income's low, they're gonna, and it says it's gonna go into Medicaid, so they apply for Medicaid, they get denied Medicaid, whether they're gonna get denied or not. If they're denied Medicaid and their income's below the 100%, or in North Carolina, it's 135% now.
Right, because you expanded Medicaid, yeah.
Right. If it's below that amount, but they're denied Medicaid, which North Carolina they won't be now because it's different. But anyway,
right, you're an expanded.
Then they can they come back and get ACA if they're denied Medicare? Or they still can't have ACA.
They can. There was a ruling that was said that if they're in a non-expanded, this was what they wanted to pass. If they're in a if somebody's in a non-expanded Medicaid state and they applied and they're denied, the system would just add the tax credit. That's what some of Congress wanted, CMS wanted, and it got voted down. But that's what they want. Some states,
but they would have to pay the tax credit too. They'd have to pay the full.
They would
amount?
have to pay 100%. No, they just wouldn't give the tax credit. So that's where some of us are saying, you know what? It's possible for you to make 16,000, right? It's possible. Yeah, it's possible. All right, I'm going to put you at 16 because we're making the system do what they want it to do, which is make insurance affordable. And if you live in Texas and Alabama and Florida and you're not a pregnant female or a 3-month-old baby, you're not getting it. Okay, the reason the Affordable Care Act was passed was so people could have affordable insurance. And I will tell you, those who complain, well, now we're just wasting taxpayers' money. No, you're not. You're actually saving taxpayers' money by getting the low-income people insurance because we're going to pay for them regardless. But if they have insurance, they'll go when they start feeling out of breath. Instead of waiting until they have a massive heart attack, have a hospital ride, they end up at the hospital and it's all written off. And do you think the hospital is actually writing that off? No, they're sending it to the state who's paying for the taxes who we are paying for. So it's kind of a broke system. And the more Congress is at each other's throats over stupid things, the less likely they'll fix it. But it is one of those things that they are talking about. It is what they wanted it to be. I really do think they had a little bit high in the sky belief that when they passed the Affordable Care Act, all the states were just going to become expanded states and do the right thing. Well, we all know that isn't how it works. So, you have to live with you. I do want you to be upfront with people. I want you to talk to them. I don't want you to hide things. Is it possible that you can make 15,000? Nope, not even remotely possible. Okay, then I can't get you coverage. Well, my 23-year-old isn't my tax dependent. They're just living in the basement. Think you could pay them to, clean the yard so that you can write, give them some money? Well, yeah, okay, that's income. How about you give them the income of what you're paying for? I'm not buying I'm not personally buying your food anymore. I'm going to pay you. And now you're going to go buy your own food. There are ways of doing this. They just have to report income. So, but if they won't work with you, nope. Okay. Then okay, you're not going to work. But nobody's going to pay back because they said they made 16 and they make 8. The IRS is not going to go after people for making less money. They don't, when you do qualify for tax credits, they're certainly not when you don't in the lower. So we are way over, well, we're 5 minutes over, but, get permission, talk to people, be upfront about it, let them make the decision and go from there. Do what's right for your client, what you need to do. If you've got a bad feeling about something, walk away. Say, I just don't think we're a good fit. It's okay to walk away. I don't care if you just started and you have 4 clients and that 5th one comes in and you want every client possible. Not worth it. If it doesn't feel right, back away. So the consent form,
Hey, Chris.
I'm including it. I know that Texas is saying we need a new consent form for 2025. Insurance company, CMS is not saying that, but I've been getting consent form every year just cause. So it's just included in the income when we're asking them for their income. Or if they email you, could you please do this? All right, you're giving me permission to do that. And they reply, yes. Well, there you go. So just cover your butt, and the consent thing, nobody's upset by that, right? Nobody's like, I'm not giving you consent. They want you to help. So, you can, again, blame the government, IRS. All right, we got to get consent, which we're doing for the attestations. I have to get the attestations every year. If I'm doing their application, well, just include the consent with the attestations. Now, if they're doing their application, they do their own attestations, but they're like, can you help me? Yeah, I would love to help you. Emails, phone calls, it's all recorded with them asking you to help. So, they're not going to go after people like that. Somebody's asking about form doctors. They're too expensive for you. There are other forms out there. I just talked to somebody who had a really very, very, very inexpensive one. I will see if I can ask him what that is and share it. There are other forms out there. You can make your own. Buy Adobe, it can be fillable. And then I did see the question, Southeast Orlando, what's the minimum amount? That's why you need the federal poverty chart. That's why you need this, because the 100% is what the minimum is. So next year, the minimum is $15,060. So I would not put in, if somebody's like, oh, I'm not sure how much, I'm not gonna put $15,060. I'm just gonna round it up to 16. And if it's a family of 5, the minimum is 36,580. So get this federal chart, look at the 100%. That's what you need to know, because anything below that goes to Medicaid. You need to know your state. Do they have a good Medicaid system or not? Ours does. I mean, I just heard somebody say we had a Medicaid expanded state before that was a thing, which is true, because the state of Wisconsin and Minnesota covered everybody below 100 percentile. Everybody for years, male, female, didn't matter. But, so you can, Jill said you can use the Health Sherpa consent form, attestation forms. But we use Form Doctor for everything. That's our intake form, our income form, our attestations, our consent. So, if you're just looking for the consent and attestation forms, just healthcare.gov. When you were there doing the certification, they had the form. That's what Health Sherpa's form is. It's just that form. Download that, So thank you very much. We're 10 minutes over. Have a great rest of the month. We will talk next week, where we get to meet Steven Weinberger. Thanks, everybody. Appreciate it.